Hi, my name is Aaron Zapata. Thank you for watching this video. I hope you find it helpful, and I do encourage any comments or feedback wherever you're watching it. My question that I'm trying to answer today is, will California home prices fall because of the rates? And more specifically, because of the rising mortgage interest rates. So who am I? Well, my name is Aaron Zapata. I do have a bachelor's degree from Biola University. I also have an MBA from Cal State Fullerton. And I've been in the real estate industry since 1996. It's been a long time. I've been a licensed broker since 2002. I'm coming up on my 20th anniversary here. I'm super excited about that. I own a real estate company. We are licensed in 3 states. I also own a mortgage company that's licensed here in California. And so my companies are greatly impacted by this conversation that we're having here today. I work in the industry and I'm a student of the industry. I love watching what's happening. I love advising my clients, and I love talking to it with my agents. And so I'm sharing this information with you, the public, so that you can have an understanding from where I see it. And where do I see it? Well, I had a front row seat back in 2007 when the housing collapse happened. I remember at the time I ran a mortgage division within the real estate company that I was running. And right at 11 a.m., we funded a loan. At noon, that company closed. And it was the first company to close at the beginning of the housing recession. And everything just fell apart from there. But I remember it. I remember seeing it. I remember the carnage. I remember the difficulty. And I'm able to draw from that experience and talk to you about today's experience, to talk about the similarities and the differences of that market versus where we're at today. My primary market, just so you guys know, is here in Orange County and LA County. I am in Southern California. So I'm talking primarily about my market. And if you're outside of the area, hopefully it's helpful to you. But let's talk about Orange County. And for those of you who are looking for my real estate license numbers and my NMLS number, there you go. I put it right there in the slide. But I'm not offering you advice today as a client. You're not my client. This is not an agency relationship. I'm not your loan officer. I'm coming to you as an industry professional who understands the greater economics of what's happening in our industry and in the United States, and trying to show you how it's going to affect our market here today. So if you are interested in the loan, or you do want to have some sort of advice pertaining to your situation, please contact me privately and we can go through that process. But let's move on. Back in 2007, versus 2022. What was the difference? Well, this stool here is an image that I have in my mind of the housing market, and it was supported by 3 basic pillars. The first pillar was all propped up on easy money. And you guys know this if you lived through it. First-time home buyers could get into a house for little or no cash. I had one client that bought a $560,000 home for $1,200 out of pocket. That's right. That's all it cost them to get in. First-time buyers could get that little or no down loan really easy. In fact, we had ninja loans, which are liar loans, which were no income, no job, no assets, no problem. So long as you could fog a mirror and you breathe, they would basically give you a loan. Investors also use these loans. This is the other pillar. Investors were buying properties, holding them, flipping them for a great profit, and they were using that cheap money. And then also we had traditional buyers and sellers. These are the buyers and sellers, the sellers who owned homes that said, hey, our house is worth a lot, let's sell it, and let's buy another house with that equity. We call that trading equities, so long as they put that money back into a replacement home. We also saw in the 2007 market a lot of homeowners drawing on home equity lines of credit, going out and buying things. And of course, a lot of those people lost their homes in the recession. But that was back in 2007, was subprime at its finest. They don't call it subprime anymore. Now they call it non-QM, non-qualified mortgage, which basically means it's outside of the parameters that the government likes to insure. And if you don't want to do those QM loans, they're called non-QM, and those are completely different from what's happening for the most part today. It is hard to get a loan. You do have to show your job history. You do have to have money. You have to have income. You have to have assets. All of that is making today's market a lot stronger. But the pressure we're experiencing today is not coming from the easy money and the pillars falling out. We are finding that we are under economic pressure. we have higher interest rates all across the board, not only for mortgages, but also for consumer debt, for credit card debt, for car payments, student loan payments. There's a lot of things out there that have gone up because the Fed has continued to raise rates, and those are the consumer rates that they're raising. And then mortgage rates have gone up because there's more risk in the market, and the banks don't have the tolerance to issue low rates on their mortgages anymore. So that's the economic pressure. We also have higher gas prices. Who knew that we'd be paying $6, $8 in some places, $9 in some places to fill our tanks, right? It's just expensive. And that means that we're experiencing inflation. Inflation is when the price of everything goes up. And when prices go up and it outpaces our earnings, buyers start, and everybody starts to cinch in that belt a little. They start to spend a little bit less because they know that they need to save for the essentials like gas and like food. And because of that, we are now on the verge of a recession. And that weight is like an elephant in the room that's just sitting on the housing market, trying to make it collapse. And the question is, will it? I drafted this little image here of a triangle. It's not specific to any actual data, but we all know this to be true, that the higher the interest rate for any given product, the fewer people can afford to buy it. And in Orange County, we know that the average household income is $144,000. We know that 59% of the households earn less than $125,000. And so when you look at the area of a triangle, if you go from the bottom to the top, we see at the bottom, if it's 3% rates, let's say everybody qualifies. Everybody qualifies at 3%. It's not true, but let's say everybody does. That's the entire area of the triangle. Well, if rates go up to 6 and on the way to 9, right, they go up halfway, and we draw a line there like I did, you'll find that 75% of the area of the triangle is actually below the halfway mark. So if rates go up, it's a disproportionate number of borrowers that are sidelined or can no longer afford to buy a home. And that's true. It's not specific to these numbers here as the area of a triangle, but as a visual, the higher the rate, the disproportionate number of people are set aside and can no longer afford to buy. Well, let's talk about the Orange County household income. I just alluded to it briefly. This website, OC Healthier Together, has shown the 2022 demographics. So this is this year household income, and they've categorized households according to earnings. And here they show in that first row that households by income under $15,000 per year, there's 63,749 homeowners or households in Orange County that make less than that, or 6% of the total households. Well, I drew a line right here because at that line, we see that 59%, so everybody above that line, 59% of households in Orange County earn less than $125,000 per year. They earn less than $125,000 per year. $144,443 is the total like average household income for the county. But we see here at the very bottom tier that there are 60,000 households in our county, almost the same as the very first line, that earn 500,000 or more. That means they could earn millions. Okay, they stopped counting. They just 500,000 or more. 5.73% of the county earns 500,000 or more. So there's a lot of buyers out there that can still afford higher prices. And in fact, you might be surprised that with an average household income of 144,000, that our average sale price in Orange County in June was 1,315,000. We'll talk about that shortly. I found this great slide because it shows us what mortgage rates were back in February versus what they are right now. Back in February, a 30-year fixed mortgage was a loan amount of interest rate of 3.82%. Now today, last week, these numbers were compiled and published on Monday or Tuesday, excuse me. It was 5.6%. Now, good news since I'm recording this, and I saw an article today that this rate actually has dropped down to 5.3%. So prices are coming down for mortgages. Rates are coming down for mortgages, which is great, but it's still up from where it was back in February, and that affects how much borrowers can borrow. So let's look at conforming loan amounts here in Orange County versus the payments at the different interest rates. Now, back in June, the average sale price in Orange County for all properties was $1,315,000. If I took out all the condos and the other things that we sell, the average house sold for over 1.7 million. But let's use 1.3 million for my example here. With a 26% down payment, your loan would be $970,000. Now that's in line with that yellow bar that I showed you on the previous slide. Okay, so information here is very important. When you look at rates back in February at 3.8, at a $970,000 loan, your mortgage payment would be $4,520, and your taxes and insurance is estimated at $1,575 for a total payment of $6,095. But with the new rates at 5.6%, that same loan would cost you $7,144, or an increase of $1,049 per month. And that's an actual increase of 23% per month on your mortgage payment. Now, the average household income needed to borrow that kind of loan would be $209,000 per year. Now, I have loan officers right now watching this, and they're screaming at me saying, wait a minute, we can borrow more than 35% of your debt to income ratio. We can borrow 40%, 50%, whatever it is, depending on the loan. And that's true. Thank you, loan officers, for pointing that out. But let me explain this based on what I see with my clients. I don't have many clients who are comfortable spending more than 35% of their gross income on their mortgage payments. And let's just do a simple example here. If you earn $10,000 a month for your household and you spend $3,500 a month on your mortgage payment and your property taxes and your insurance, you're at 35% DTI, debt to income ratio, on what they call the front end ratio. So that's the number I'm using. Why do I use 35%? Because if you earn $10,000 a month, and let's say you spend 25% of that on taxes, now you're down to $7,500. Let's say you have 2 car payments because you have 2 jobs and you don't have your cars paid off. That's another $1,000 or more. That drops you down to $6,500. You have a $500 a month gas bill. That drops you down to, $6,000 or $6,000. And then you have food, you have electricity bills, you have other transportation costs, you have if you have kids, you got expenses for the kids. If you want to go on vacation, you have vacation. If you buy gifts for people, you could drop that down to $4,000 real quick. Are you comfortable spending $3,500 or the remaining balance on your mortgage? Well, a lot of people are comfortable with 35%. So that's the number I'm using. In February, you needed $209,000 per household to buy this house. Now, at 5.6%, you need $245,000 to buy the same house at the higher interest rate. That means you would need to have an increase in pay for your house of $36,000 a year, or $3,000 a month, or a 17% increase in your income. I don't know a lot of people that between February and now have had an increase in their monthly pay of $3,000 a month in this example, or 17% in whatever example you're looking at. So what does that mean for you? Well, that means that you can no longer afford the old prices at these new rates. In fact, only approximately 15% of Orange County households can afford those old prices at the new rates. So no raise, what can you do? What can you afford? Well, let's work backwards to show how loan amounts are affected by those interest rates. So in order for a buyer to purchase the same priced home with the higher rate, they would have to either have an increase of 17% in their earnings since February or borrow less. How much less, you ask? Here's the answer. In February, that 3.8%, $6,095 per month payment had a loan amount of $970,000. Well, if we want to keep the same payment, the $6,095, we have, at the rate of 5.6, we have to lower the loan amount to $787,000. That's a decrease of $183,000, or a decrease of approximately 19% in your borrower purchasing power. So without the increase in earnings, you simply borrow less. Now, I want to show you that this price point, these numbers are the same at all the different loan amounts. For example, If you were borrowing $850,000 at 3.8%, that would, at 5.6%, you could only borrow $689,000, or a decrease of 18.8%, almost 19%. If you were borrowing $750,000 before, and now you have a 5.6% interest rate, you can only borrow $608,000 in order to maintain the same payment. Again, a drop of 18.8%. If you're comfortable with a $3,000 loan payment and you're borrowing $650,000, then your loan amount would have to drop to $527,000 to maintain the same price. Again, a drop of 18.8%. So it doesn't matter where you're at this pricing tier, the borrower's ability to borrow has been decreased by close to 19%. So does that mean that home prices are going to fall guaranteed? Well, how can we stop home prices from falling? If borrowers can't borrow more because the interest rates went up and they have to borrow less, I'll let you draw your own conclusion. But what could stop the falling home prices? Well, we could see that mortgage rates drop. And in fact, in the last 2 weeks, they have. I was previously recording this at 6.1% interest rates, and I decided to wait because I went on vacation. And guess what? While I was gone, rates have dropped twice in a pretty big fashion. And so mortgage rates can continue to drop, which would stabilize prices. Natural competition could cause that. The subsidized government subsidies could solve that. Or, you know what? Fears of recession, like we've seen, could cause the mortgage rate to drop. When I say subsidized by the government, let me explain what I mean. Maybe the government would come up with a program that says we need to help homeowners. Let's pay the interest for 4 years, or a portion of the interest for 4 years. Maybe they would. I don't know. I'm not in the government. I'm not making decisions as to what they're going to do, but they have been very creative in the past. And I know that the government does not want housing prices to fall. So they might subsidize, or perhaps they began to buy the loans again. In fact, in COVID, the government was buying the loans, and that made banks very comfortable lending at lower rates because they could sell them off to the federal government, and then they would not have any responsibility if all those mortgages went under. And so that created low rates, as was one of the reasons. Also, lenders could say, hey, let's just increase the maximum qualifying ratios. You know, they could borrow more. Instead of 35 debt to income ratio, they could go up to 50 or 60 or 75. Well, I know that borrowers have to agree to those things, but that's one option, right? Another option to stop falling home prices is low inventory. If we've eliminated 75% of the buyers, but haven't increased the inventory by a proportionate amount, we're still going to have more buyers than homes. As long as we have more buyers than homes available, that's going to keep housing prices stable. Because as I said before, fewer and fewer buyers can borrow, but so long as the number of homes available is less than the total qualified buyers, prices can remain stable. We could also ask and pray for inflation to get reversed, right? Well, let's reverse the inflation. We know that's not going to happen. So when will prices stabilize? And I say when will they stabilize because we are seeing that they are slowing. In fact, the research that I've done here locally shows that we have 30 to 40% of the homes, depending on the market, have had price reductions as they, wait for buyers to come by. Sellers get antsy, sellers get nervous, and so they reduce the price because they want to get that home sold, because if they believe that home prices are coming down, they want to maximize their equity, so they do price reductions. So we are seeing price reductions. We are seeing prices stabilize. When will they completely stabilize and not go down more? Well, if prices were to drop 15 to 25% from today's values, absolutely, I think all those buyers are back in the market, even at the higher interest rates. And if that doesn't happen, if rates drop back into the low 4% range again, I think borrowers are going to be happy and they're going to jump back in. I also know that if borrowers are getting more money in their paychecks, then obviously they're going to be able to spend more. And at some point, buyers will get comfortable with higher rates, and so they will begin to borrow again, even at the higher rates. And also, if inflation is under control, prices will stabilize, which means let's get lower gas prices, lower grocery bills, lower utility bills. Let's go for all of that so borrowers can spend more on their loan, or government action could be taken to lower the rates. So that's how mortgage rates impact the housing market. Now, the question I get is, why would buyers want to buy now? And there's a couple of great reasons, because rent right now is throwing away money and rent is going up. You are paying somebody else's mortgage, you are paying for somebody else's vacation, and every time you rent, you write a rent check, that money is going towards somebody else's benefit and never towards yours. And rent goes up in a housing market that is going down, because homeowners who have been owning are now selling and they need to rent and they've got cash and they're going to drive rents up. Also, if you want to buy now, perhaps you're going to trade your equity, you're going to sell your one home and buy another one. That's a great reason to buy now. Right now, if you've been searching for a home and you are been beat out for months with multiple offers, now you're going to have less competition. And also, if your dream home becomes available, buy it. Those great homes only come on the market every 5, 10, 15 years. So if that house you've been waiting for, it's less about price and more about your dream and about where you want to be, go buy the home. Whatever the reason is that you've been waiting for that neighborhood or that specific house or that school district or that city, and that house is available, now's a good time to buy it. So if you're looking for specific goals, specific needs and schools, now's a great time to buy. And again, loans are available. If you have a good job that's stable, you've got your down payment, and you don't want to rent anymore, and you own that home for 10, 15, 20 years, you're going to be in a great spot. So timing in the market is not the suggestion, but putting your house, getting a house and remaining in it over a long distance, a long period of time is the suggestion. I think it was, I forget his name, but he said timing the market versus time in the market. You want to spend time in the market. If you're looking to buy over the next, right now and stay in there for a year or 2 years and wait it out, might not be the best time. But if you're looking at living in that location for a long time, go ahead, move forward. That's my presentation. Thank you guys so much for watching. I would definitely welcome your input, your thoughts. I want to know what you think. Are you a buyer waiting to buy? Are you a seller looking to sell? Comment below so we can have a dialogue about it. God bless you. Thanks for watching. Hopefully we'll see you soon.